First off, welcome. Thank you for spending some time this afternoon. That was a great presentation by Paul there in terms of looking at the economic side of things. Obviously, I'm going to get into the marketing side. I spent a lot of time just kind of talking about where we are in terms of a snapshot of the markets, supply side of the equation, what's going on there. It's very hard to go through and give specific thoughts and strategies at the, right off this moment. We'll talk about at least where we think some things might be moving to and what's out there. All we can basically say is we've got a lot of opportunity that we did not think was going to be here 6 months ago. The market has changed dramatically since the middle of August. And from talking to, obviously through my producers, what felt like a very, very difficult year in terms of their marketing plans and what we're going to be put in front of them because of the COVID situation, as well as just the supply situation, and especially in the grain and the corn market has very quickly evaporated. And now we got a ray of hope that I think we can put to use here for the next couple of years and start building some base. So with that, I'm just going to kind of go through and talk a little bit. Again, we'll get into mainly the corn and bean markets. If there's any questions regarding wheat, or any of the other markets at all too. Again, focus for me today was grains, but if we got some time, if anybody wants to talk about obviously dairy or something of that nature too, I can cover that later in the question answer session. But immediate thoughts about the market right now. This is a demand-driven market at this stage. Demand, demand, demand. That is all it's been about since the middle of August, realistically since the end of July. Whether it's because of the phase one deal, I feel it's more because of the opportunity that China is looking for grains. They have some need. Our prices were where they need them to be compared to the globe, and they have been a very aggressive buyer. With that, it's brought something back to the markets we haven't seen since 2015-16 in terms of this export demand. And now on top of that, we're starting to see tightening supplies because of the weather here as well as abroad. Prices are obviously reacting accordingly. Quick overview, corn supplies are tightening. Overall, still adequate. We'll still kind of cover that, but there's still a lot of questions where that corn market can be. Maybe that's some of the reason we're seeing the performance between corn and beans act the way they have been over the last few weeks, where beans have been basically on a skyrocket move. Corn has had its days, but then kind of seems to be struggling like we've actually just seen here these last couple of days. Soybean supplies tightest in years. As I get into some of the numbers that we're going to be looking at today, you're going to see how tight this picture is. Definitely here in the United States for beans, brings a lot of optimism where prices can get to over the next calendar year. What's going on in the South American weather, that's just the big talk. We'll touch on that a little bit as we kind of go through production cycles. But South American weather right now is clearly the focus, especially in the soybean market. We're a two-crop market nowadays. We got the U.S. market or U.S. harvest in the fall, South American crop coming through in the late spring, and those two basically will set the tone for soybean prices for the rest of the year. What's going on in terms of China? What's going to be the impact? We're still got a lot of question marks there. Obviously, they have been buying corn and soybeans at record levels, not to mention other ag commodities. Are we going to get those bushels out the door? That's going to be the biggest question, I think, going in front of the market into the spring. I'll touch base on that a little bit when I get into those fundamentals. And then lastly, too, we'll just spend some time. What do we do with 2021? Again, like I said a few minutes ago, we got some opportunities, I think, here to start looking into things for the next couple of years and building some base. And that's what I'm going to really be focused on as I talk with my clients in terms of what are we thinking about as we move forward. So with that, let's just kind of go into the corn market. Let's talk a little bit about the fundamentals. We obviously had a USDA report this week on Tuesday. Major surprises came out of that report as the USDA decided to shave 460 million bushels off the carryover projection for this corn year. That is basically an unprecedented chop in terms of this time frame, in terms of bringing those bushels down. Started first off, if you think about it, and actually Paul touched on a little bit, Wisconsin itself had a very good year. We'll cover the breakdown on the state yields here in just a second. But even nationally, we were trendline yield. So this reduction that we're seeing in the crop size in terms of the carryover projections, that's more due to the demand side of that market that's really coming into play. Because overall, we've had a solid year. We're still putting out 14 billion bushels of corn again this year. So that's nowhere near a miss. I mean, you go compare that to basically last year, we're at 14.3. So we still got a lot of crop being produced. Still down overall, but still a solid crop. even despite some of the hardships that we've had. If you go look at state breakdowns on yield, again, as Paul mentioned, Wisconsin putting in a record yield at 184 bushels an acre, but that was even down a bushel per acre off this latest report. Realistically, 13 states saw reductions in yield. Now, the question going forward is, are we done here? Or are we going to tighten the supply chain up even further? We won't see a whole lot of news on that until we get to the January USDA numbers. When we get those final yield projections, expectations are the supply side of this equation will tighten down even more so as we're finishing up these harvests. Continue to hear those mixed to disappointing yield results from producers across the entire grain belt overall. Even talking to some producers here in northern Wisconsin that I work closely with, they were really optimistic how things were, but that August weather really did have an impact. And I would say the yield probably will come down even further as we get into that January report. So let's take a look at the supply side of the equation and where we are in that overall. Now, realistically, again, we saw the corn ending stock number. That's basically the bushels that we have available at the end of the marketing year. That dropped down to 1.7 billion bushels. That was, like I said, a 400 million bushel drop from last month's report. The market was expecting that to be around 2 billion, so we got about a 300 million bushel miss there. That was where we saw that price strength on the report day on Tuesday. On a historical perspective, you can see it's kind of middle of the road over the last 20 plus years in terms, but considering where we were last year, we are seeing a fairly significant move. And again, expectations maybe in the marketplace that number gets down into the 1.5-1.6 window if we continue to see the strength in demand as well as we see some tightening on the supply picture. As you can tell, though, that we've also had an unprecedented move in terms of this course of the marketing year. In May and June, obviously at the height of the whole COVID situation, we were concerned on the demand side of the equation with ethanol and exports, mainly that drop in ethanol production. USDA was forecasting carryover for this year to be about 3.3 billion. Yeah, that was an extremely difficult time for producers. We were making some tough decisions in terms, do we even start marketing here? Do we start using, getting some sales in? It felt like as we're in July, as you can still see in July, we're still in the upper, 2 billion bushel plus window before we started falling apart. What do we protect? At that time frame, it felt like this market was on its way to sub $3. And obviously since then, we've shaved about 1.6 billion bushels off of that ending stock total. So as you can tell, now we're looking at multi-year lows in the last handful of years, and the trend continues to probably work itself downward. So that'll be something we keep an eye on as we move forward into the 2021 year. Where does this trend go? Do we continue to fall, or do we finally find some stability? Obviously, we'll have to continue to keep an eye on what happens with COVID. Do we see some lockdowns again here in the United States? What's that do to the, one of the biggest drivers of domestic demand, which is the ethanol production? And that could be a big factor that weighs on whether this carryout number continues to slide or start to level out. To me, over the carryout issue is the stocks to use. Stocks to use is basically the amount of available days that we have of corn supply here in the United States. With the report this week, we moved that down to 11.7%. In other words, you take the amount of available bushels, divide that into the demand side of the equation, comes out to that ratio. At 11%, that means we got about 41 days of available corn supply at the end of the marketing year. Okay, so not exactly tight. If we get that under the 30 level, that's when you really start seeing the market get a little bit nervous. We were at 11.7. If you start getting under 10, like we saw back in 03 and back and even into the drought years, 13, there's 12, 13, now the market really has some concerning point. So that number, again, getting under that 10 level is going to be probably something we'll watch if that can happen down the road due to tighter supplies or as well as more demand. There's a comparison. Last year we were pushing 14 plus. Just even go look at a prior year to that. Here's 18, 19, we're over 15. And obviously we saw how prices kind of relate. Doing a little bit of outlook. There's a lot of noise going on in this chart in general, but just kind of taking a look at a potential range of prices during the next basically marketing year here as we get into the end of this winter and into the spring and summer. Here's 2021 stocks to usage ratio. Again, we said that was around 11.7%, with the yield at, or excuse me, acres at 91, yield at 175, gives us a possible pricing range 3.25, 450, 460 on the top side, you know, as a range. And again, obviously we can see some adjustments within that window based on what happens to that carry out projection or that stocks to use projection in the reports ahead. So, but this is at least kind of our starting point right now. And as we're looking at, you know, you start thinking where prices are for this year, July corn 420-30 level, you know, we're starting to maybe be in the top end of that range. So that's something, as I'm talking to my producers about, is, you know, making sure we're staying focused on the cash market. A lot of good opportunities out there, and what we can work with that in terms of protecting the value that we have in this market, whether it's through sales or using defensive strategies, and then still somehow make sure we're available in case we tighten up more and we do push to this top end of the range. World supply side of the equation looks a little bit heavier. Obviously, we got competition between South America and the Ukraine, as well as other countries, but those are the major two when it comes to the export side of the equation. As you can see, world supplies slightly below last year, so still the world has ample supplies of corn, at least according to the picture that we're seeing from the USDA. Now, a lot of that ending stockpile is still estimated to be in China. A lot of questions regarding the amount, the quality of that crop. You know, they're active in our markets right now looking to purchase corn. Obviously, they got corn prices at record highs in terms of their domestic supply, so that's what's been bringing them to our market. World stocks use ratio, again, like we were talking about, middle of the range, very close to last year's level, so that still keeps me a little bit cautious of the corn market in general, that we do have ample supplies. Obviously, we got to look at competing grains and too when it comes to corn in terms of the feed usage side. The wheat market, we saw world wheat supplies 320 million metric tons, still very plentiful. Probably some of the reason we've seen the pressure on wheat prices this week after the report came out. So again, that still kind of weighs in terms of the corn market as well. Biggest things that we're focusing on though right now, talking a little bit about that demand side of the equation and some of those other fundamentals that are driving this market right now. Export commitments or export sales on the books. As you can see, we're at a record pace and that continues to stay extremely strong. Obviously, China stepping into the market, buying corn as aggressively as they have has been a big factor, but we're also still seeing those traditional buyers come in and play. Mexico, Colombia, you know, some of the grains going over into Europe as well. So it's encouraging to still see some of those traditional buyers staying in this window. One of the biggest numbers or things we were watching on the report this last week, what happens with Ukraine? USDA did lower their forecast by about 11 million metric tons in terms of grain. Okay, that's about 430 million bushels of available supply that is an exportable supply. This report, the USDA moved our export expectations up to 2.65 billion. They raised it by 325 million. That 2.65 is a near record level of export expectations. Again, that's probably a direct reflection of that drop in the Ukraine production and the competition that they would have provided on the export side. Also, you've heard a lot of news regarding what is going on in South America. Brazil at this moment seems to be on very minimal supplies of both corn and beans, and they've been stepping in even to the U.S. market and buying beans, and we expect them to step into the U.S. market to buy corn as they've been aggressive in their exports and basically have tightened their supply windows and elevated those prices. So those are things that are still extremely favorable for the corn market here in the shorter term, at least in terms of those export commitments. Biggest thing with those export commitments is getting those bushels out and getting them shipped. The other side of demand that is responsible, obviously, for about 1/4 of every bushel, that, or one of every 4 bushels that we're working in the United States, is where we are in the ethanol production. Obviously, this was the height of the COVID lockdown situation where we saw ethanol production drop as gasoline usage has dropped. We've recovered nicely, but we're still running about 10% under previous year's levels. That's still an area that we'll have to keep an eye on. Even today's export or ethanol production numbers still showed us slightly lacking compared to where we need to be at this time frame. That may be something that'll add back to that corn stockpile. You know, in the past, when we get into that the January, February, March window, USDA has always seemed to find ways to add to the stockpile overall. somewhere because of lacking on the demand front. This year may be an exception, we'll see. But at this stage, we're still cautious on that side of the equation, still keeping a little bit extra supply in terms of the entire crop in here in the United States. One of the other factors that's also most concerning right now too, we talk about managed money and money flow. These are the speculative funds and how they've poured into the corn market. As you can see, as of last week's commitment of traders, about 290,000 long contracts. As an explosive rally we've seen in that since August. And to the point now we're sitting at a record level of length. All we need is some news of some sort, or just a time frame where they say we need to move to the sidelines, pull the profits out of this market. Fundamentals won't matter. This market will turn over, and as we see that profits taking. Maybe that's a little bit of what we got going, last couple of days. We kind of got that report out of the way. We had a bullish response. Now we're seeing some money maybe move to the sidelines in the corn market. Again, still overall picture still relatively heavy, okay, or at least ample supplies to the point we're not in a panic mode. And we'll see how that plays out. I'm also kind of concerned as we move towards the end of the year. A lot of times when we see elevated positions with profitability in them, we'll just see general profit taking as we move into the end of the year. And that could, again, put some pressure on the market until, at least until maybe the first of the year. And then we got that potential for some snapback if the supply side of the equation stays tight or gets tighter. So let's just take a quick look at where prices have gone, prices have been. Obviously, the height of the COVID shutdown situation. Again, this is when we were still talking 3 billion bushels of corn for this year. Market was just basically, at a very tipping point where it felt like any day we could have broken and made that sub $3 move. Obviously, then we got the reduction in acreage off the June report, which kind of changed the picture. But again, the supply side of the equation still stayed heavy despite those reduction in acreage. Then we got that August report, which actually gave us a negative numbers that were negative overall. But in turn, though, the market got into the buy mode. And again, if you go back to that managed money chart, you can see when they stepped into the market, and they've been driving this price higher, since that window. Expectations now, really kind of watching this area that we're working now. These were prices as of yesterday afternoon. We did drop another 7-8 cents in corn today, so we're down pushing this 405, 406 level. If we can hold in here, I think we got a chance to maybe we can work this a little bit higher. I still think that may be more of a springtime type move, but there's still some good value out there. One of the things I've really been talking about is I say, look at where we are compared to previous years and the opportunity maybe to get stepping into 21 contracts. If you look at the contract high last year, we were sitting around 420 or so in that December 21 corn. I've been working producers. We've been getting some ownership positions in early. Now with the intent, if we get into the 415, 420 area, we're going to start stepping our toe into the market on the cash sale front, whether using some strategies where we lock in the futures and set the basis later, or go ahead and start doing some cash strategies, but at least knowing that we already have some option potential in the market working to the upside to keep some insurance over top. As Paul touched on too, in terms of the drought monitor maps, we do have a lot of dryness that is out on those maps. If weather over the winter doesn't replenish some of the moisture conditions that we need to see in the Midwest, we could be off to a dry start if this type of weather pattern holds. And that could be something that we'd be building some upside potential. So a lot of times right now when markets are moving like they are, the terms I use with the producers is sell the fact, which is the prices we got now, find a way to own the potential using upside strategies, whether call or futures positions, and making sure you stay available to the market in general. So a quick summary in terms of where the corn market has been in a historical level. This gives you a little better idea than we're looking at long term. This is a monthly chart on corn. As you can see, we made our turn in the spring, very bullish uptrend. This 420 level is a very key area that we need to hold. Obviously, we can see we haven't spent a lot of time above 420, going all the way back to basically 2014 window. If we do get up above there, it will probably be very short-lived, and that's going to be that opportunity for producers to make sure we're active in that cash market, building some base for next year, or building some base into the spring. If they still are optimistic regarding upside on prices, then we got to use defensive strategies that keep that upside open, but at least make sure we're taking care of the checkbook and balancing the floor overall. So the next couple of weeks could be very key, at least in terms of maybe making this push up to that 450 level. Again, that's still going to come from the positive news. We need to continue to see demand stay in the market in front of in terms of export sales. That could be a little bit more on the quiet side now till the end of the year. But then we get that January report. We'll see if we get any further reductions in terms of the size of this crop or the available supply. Soybean market is a totally different situation compared to the corn market now because of that Chinese demand stepping back in. If we go take a look at where we are in terms of yield, again, trend line yield, we're still actually a fairly solid crop at 50.7 bushels per acre. Again, a lot of question marks that yield can hold. That was a fairly big cut in terms of that yield, losing 1.2 bushels per acre on that report on Tuesday. But that August weather was a major impact, and that was some of what we had get priced in when that August report came out, was the fact that that was right in the window when we need to get the pods filled, and there's still a lot of questions if that yield number will still come down as we move further in the January report. State by state wise, again, Wisconsin, 53 bushels per acre, actually had a fairly big drop, about 3.6 bushels per acre. Again, that was reflective of that August weather really coming to play. But as you can see, you go look at the main, core states. Of the top 10 states, all 10 had yield reductions on this last report, and there's still a good possibility that we could see those numbers even tighten further. As we look at the supply side of the equation for beans, it's a totally, like I said, different situation than corn because of the strong demand overall, even though production's still, relatively solid at 4.1 billion bushels this year in the United States. As you can see, that ending stock number comes down to under 200 million bushels. We don't typically spend a lot of time down underneath that level. As you can see over history, it actually puts us extremely tight here for this time frame. The majority of those ending stock projections you see there occur usually in the later months, so it brings a little bit of optimism where price can be, that we're already talking those types of levels here in November. As you can see, like I showed in the corn market, again, we were pushing 600 million bushels of carryover just a couple in that August report, but now we're looking at sub 200, which is an extremely, extremely tight crop and stockpile over the last handful of years. Again, going back to that stocks to use ratio, soybeans right now is at 4.2%. As you can see, it's basically the lowest run in about 7 years. And in a historical standpoint, only 13-14, the year after the drought, is any lower. So with that, that gives us a lot of volatility in price. Again, kind of like in corn, here's where we are in terms of our current stocks to use ratio, 83 million acres, 50.7 bushels per acre, and the yield gives us that stocks to use of 4.2, gives us a price range from basically low 12 or sub 12 to possibly the $14 window. I was talking with a few producers this morning in terms of how prices might work. Again, we talk about this two-crop system between us and South America. Still favorable for price now, even though it feels like we're resting a little bit here after the report. Still think we got a chance maybe by the end of the year we do push to the $12 mark. So I'll have to kind of see how the money flow goes into that. I think that'll also be based on what happens with outside market as well as demand news. So that South American crop continues to get produced. Brazil's weather is improving. So they're going to still put out 120 to 130, maybe more million metric tons of beans, which will be a record production for that level. That's going to put some pressure on prices as we get into the February, March, April, May window. Don't be shocked. We see bean futures really roll over as the funds liquidate some of their long positioning, but that could set us up very nicely for a summer run as U.S. end users get back into the picture and realize that the supply of beans is not here, and we could see prices really kick in the summer months again. That's probably when we get to that window when we start challenging the top end of that range as a possibility. To sit here and bet on $14 beans and holding beans and supplies to do that is actually kind of risky. Obviously, the odds of that happening may not occur. Again, that's why producers should take advantage of the sales that they got now, build some good base, but then come back and find ways to re-own those beans into that summer months. They can possibly benefit from that price rise that could come in front of us. If we start seeing that carryout number slip under the 100 million bushel level or get tighter to that 100 million bushel level, it's going to be very interesting to see how aggressive the end users will be in terms of determining price. And the other thing that's a big factor, we're estimating that maybe U.S. producers are about possibly 70% sold of this year's bean crop. So nothing moves prices faster as when the owner, the producer gives up that ownership and it moves into the market. On the global scale, supply sides, it's still a little bit heavier, obviously, with the amount of production globally, mainly in South America, as well as the stockpiles of beans. So you can see we're still relatively tight there. Ending stocks use ratios in the middle, still a multi-year low in terms of that stocks use ratio. So we're still really focusing on the demand side of the equation and the competition that we're going to see globally. This is the estimated production. Brazil is now the world's largest producer of soybeans, 133 million metric tons. United States is at 113. Argentina is still a very key market to watch in terms of soybean production, more from the protein feed side in terms of soybean meal. If they have any issues in their weather this winter into their harvest window, you know, we can see that elevated meal price, which would come into play in terms of protein. We've seen U.S. beans rise nicely in terms of value when we've seen tightness in Argentina meal, because they're the #1 supplier of soybean meal to the world. And if they don't have that meal product, then obviously the end users globally turn to the United States. Export sales has been on a blistering pace at a record level. Obviously, China has been responsible for approximately 65 to 70% of that, so it's nice in terms of that regard to have them back in the market. A couple of reasons why they've been so strong in the feed market for both corn and beans. First off, as you've obviously known, they've been suffering from African swine fever over the last year or so. They're getting their hog herd reestablished at a better level in terms of production, more confinement type operations. So the feed demand has become very, very key, and they're looking to get fresh, clean feed supplies into their country to help meet that demand. So that is something we're going to continue to watch, is how that hog herd is coming along, what's going to happen on that feed supply. The next question on that, though, how are we doing on the shipment pace? Okay, obviously every year we're concerned about, at least in the past, when we got strong Chinese export sales, do those beans get on boats and get overseas? As you can tell, we're on a very, very strong pace to start the year. We're seeing shipments pushing the 2 million metric ton level on a weekly basis. So that's been extremely encouraging. The other thing too to think about is the fact that they bought a lot of these beans in July and August when we were pushing the $8.50 sub $9 prices. Global prices have skyrocketed since then, so there's a very strong chance we won't see those exports cancellations this year, because of the fact that they got a good deal in terms of getting these beans in, and probably better than they're going to see in the world market even as they move into the summer. But that'll be still the biggest thing we'll watch as we get into February and March, when those fresh South American supplies come on board. Will they continue to be importing U.S. beans, or do we start seeing those cancellations, which could really go away on those prices, like I said before, during that harvest window when South American supplies come on board. Two other things that are a big factor, at least in the bean market, is currencies versus the U.S. dollar. Brazilian real has been extremely weak versus the dollar, and that again helps aid their pricing in terms of how the Brazilian farmer is setting up on their sales. We are estimating right now the Brazilian producer is probably 50 to 60% sold on this upcoming bean crop in terms of already pre-sold, even as they're putting the beans in the ground. That will be something that will be supportive of a price, obviously, because we'll have a lot of beans come in the market that aren't priced, and that'll be something that we'll have to keep an eye on as we move into that harvest window. Secondly, where's the Chinese yuan versus the U.S. dollar? Obviously, you can see in July when it's made that turn, it's not a surprise that we've also seen that strong uptick in Chinese buying, whether it's U.S. grains or other agricultural products, because their buying power is increased. Also very concerned that does the Chinese yuan get devalued by any time during the Central Bank of China? If that does come into play, that could be seriously a major push on the soybean market. If you do take a look at the bean prices and you laid it right over top the Chinese yuan value, they're pretty much a mirror step-and-step type move. So again, that value of the yuan versus the dollar is going to be key. Obviously, with the monetary policy here in the United States right now being very, very supportive of a weak dollar, with the amount of liquidity we pumped in through the stimulus packages and low interest rates, that's still going to also be supportive, I think, in the export front down the road. Managed money, we talk about where they are in terms of their positioning. They've pushed it to a record long just recently and have backed off. So feeling like they're probably going to be in a bit of a sideways fashion. Right now, they still got a lot of reasons to hold on to those long positions because of the size of the supply picture. So it's going to be interesting to see how that plays out as we move into the end of the year. And do they step back in and hold that length? You know, money flow is one thing that's totally, again, separate from the fundamentals. That speculative, that hedge fund marketer, excuse me, or purchaser, you know, they're looking at trends, money flow overall, and right now those trends in the bean market are on the higher side. So again, taking a look at January soybeans, this is, you know, basically going back through the spring. You can see how difficult things were at 8.50. Again, we're looking at a report that possibly could have broke us to the $8 level. We got the numbers to do that, but then the weather turned, and that's when the buyers stepped into the market. And now obviously pushing 1160 on that high on Tuesday. We backed off the last couple of days here on some profit taking. But again, it just feels like the market's resting, looking for some more news to go ahead and make that next rung up on the ladder. If we do fall back, it would possibly still stay extremely supported. You know, you'll see in a moment on historical values, we don't spend a lot of time between 11 and 12. We're either on our way through it or on our way from it in that regard. So we're really kind of optimistic that we can see one more push out here, maybe going into the end of the year, especially if we continue to see some more Chinese demand, which we still expect to stay in front of the market. As I've been talking again, like with corn, producers need to keep an eye on next year. We did push the 1030 window. I'm already kind of telling producers we get to the 1050 area. That's the window I want to start stepping in and making sure we're starting to build some sales, having some ownership over top of any early sales in this window, or again, start thinking about put strategies and make sure we're protecting the floor. Biggest thing we want to make sure we protect is that harvest window. Again, when those South American beans come on board, we could see ourselves a very strong rollback on bean prices back down into that 950, even sub 950 levels. If we do see a good harvest come in from South America and the demand side of the market does kind of wane a little bit. Long-term projections, and again, this is going to be the interesting part to see how far we go. Again, we're talking at bean levels that are very comparable to 13 and 14. You know, we did take prices, obviously, that's sub the drought into the 15 window. Last time we touched 12 was back in 2016. And as you can see, again, here's that 11 to 12 area. You can see we don't spend a lot of time in here, and we move through it fairly quickly. So it feels like this market wants to go ahead and push itself higher, just again on some of the technical buying. Again, looking at the long term, we got a multi-year low that we put in here back at the spring months, and the market has been on a nice strong up climb, technically looking very strong, which will keep money flowing into the markets overall. So again, optimism on that bean market moving forward, but it's going to stay volatile, and it's going to be moving very, very quickly. And producers need to prepare themselves for that. So again, as we start going into the calendar year of 2021, wrapping up the end of 20, get used to the fact that volatility is here and it's not going away anytime soon. When you start getting supply sides this tight, you get demand that's this aggressive in the market will move quickly. What over the last handful of years in corn was a 2-3 cent move. This year might be a 6-7 cent move like today. Or beans, it might be 4 or 5 cents like we've seen in the past, turns into 10-12 as that volatility increases. So markets have really good value. Again, I've been talking with a lot of producers about what are we doing with the bushels that we haven't priced in. You know, again, take advantage of the market that's there, but again, make sure we're looking at different strategies to keep those upside opportunities out there. As I said before, sell the fact, buy the potential that's in this market, shift your risk over. You know, the market basically, again, has that opportunities here now. Own that potential. I think this year, put strategies will be a key to protect those unpriced bushels. You know, producers will be targeting a level over the next handful of months where they want to be sold at, making sure they keep a floor underneath. We got a lot of political events going on outside of just the markets in general with COVID. You know, obviously the presidential election just recently, what's going on the global scale. Never know when that next black swan event comes. You know, what if we go through another lockdown situation? Again, you know, having put strategies underneath, if they don't work, at least you're going to be selling grain at these levels or higher. But at least you know if something falls apart tomorrow, you're not going to be saying, I wish I would have. Again, stay disciplined to targets. I mentioned that to a couple producers this morning. They're asking about what to do. I said, get your paper out, write some targets down that you want to see hit. Don't be just moving them around just because you think the market can go higher. In other words, it's not a market to be greedy in, but it's a market to build a base in. Again, build that base through your cash sales and defensive strategies, and keep that upside available to you one way or another, whether if it's keeping the bushels with a floor under it or using reownership strategies over top. Last thing, producers need to measure the risks of where we are in this market, the risk of doing nothing versus the cost of using marketing tools and strategies. It's always, producers always come at me sometimes like, I feel bad, I lost the value of this put. That's money I could have saved. I didn't need to waste that money. But if this market were to roll over and we lose 60 cents on corn, $1 plus on beans, picking up a put strategy for 20, 30 cents somehow will look very, very cheap really quickly compared to the overall risks in the operation. So that's kind of the materials I got. Didn't get into a lot of specifics, but just kind of in summary in my mind, we got a lot of opportunity in this market right now going into the end of the year. We do need to see the demand news continue to stay strong. Wouldn't surprise me that maybe in the corn market things kind of flatten out a little bit here because, again, we aren't going to see a whole lot of news until that January report comes out at the end of the year. Producers need to stay focused on what's in front of them in terms of making sure we take care of the checkbook. Don't forget about 2021. If you actually remember last year, at least until we had this rally, the best opportunity to market grain on the previous or the next marketing year was around the 1st of January. So we've got some opportunities to start thinking about those ideas and build some base and look at different strategies to keep the upside potential in the markets overall.